Hello and welcome to AI Market News by LM. All right, let's just dive right in. The oil markets are absolutely reeling right now, churning with a kind of volatility we haven't seen in years. And, it's all building up to one shocking question that's on every single trader's mind. Could we actually see oil prices hit $150 a barrel? Now, this isn't just some wild guess. It's a very real scenario that traders are actively pricing in as a major geopolitical crisis starts to unfold, one that's threatening to choke off a huge portion of the world's entire energy supply. So, what's at the core of this? Well, it all comes down to one staggering number: 20%. Just let that sink in. 1/5 of the entire planet's daily oil consumption is effectively stuck. It just can't get to market. And we need to be clear, this isn't some minor hiccup. No, this is a massive, unprecedented blockage in the very arteries of the global economy. And the heart of this whole crisis, the epicenter, is a single vital waterway, the Strait of Hormuz. It's known, for good reason, as the world's most important oil choke point. The scale of this is honestly hard to wrap your head around. Every single day, something like 20 million barrels of oil, not to mention huge amounts of natural gas and fertilizers, all squeeze through this narrow strait. So when this critical highway shuts down, the global supply chain doesn't just slow down, it faces a potential collapse. So here's where we stand right now. We're looking at more than 11 days of this complete standstill. And if we do the quick math, 20 million barrels a day for over 10 days, that means the market has already lost access to something like 200 million barrels of oil. The tankers are literally just stuck there, creating an absolute logistical nightmare. Okay, so in response to this pretty historic disruption, we're now seeing a potentially historic solution being put on the table by the International Energy Agency, or the IEA. And the number they're talking about is massive. A release of over 180 million barrels from strategic reserves that are held by member countries. This is basically an attempt to flood the market with a huge amount of supply to try and calm prices down. Now, to give us some perspective on that number, this proposed release is right on par with and could actually be bigger than the 182 million barrels that were released back in 2022 after the invasion of Ukraine. This just goes to show how seriously the world powers are taking this shutdown. But, and this is a big but, here's where the story gets a lot more complicated. Even with this enormous proposed release, market experts are deeply skeptical. As Vandana Hari from Vanda Insights puts it, this is likely to be only very small, temporary relief. So why are they so doubtful? Well, it's because there's this huge disconnect, this giant gap between the paper market and what's happening in the real physical world. You see, oil futures are jumping around based on the latest headlines. But if you actually need to buy a physical barrel of oil right now, the word is you're paying a premium of $20, maybe even $40 more. That is a massive red flag that this big plan isn't really solving the on-the-ground problem. So, with all this uncertainty, how is it rippling across the global financial markets? Well, the reaction has been a real mix of contagion and just plain confusion. At first, the news of this potential IEA release gave U.S. equity futures a little bit of a boost. We saw some modest gains in the S&P 500, but the Dow and NASDAQ were kind of mixed. But that brief sigh of relief, it really doesn't tell the whole story. Because when we start digging into the deeper market sentiment indicators, a much more nervous picture emerges. Despite that little pop in futures, the underlying emotion that's driving the market right now is leaning heavily toward fear. And a classic example of this is the flight to safety we're seeing play out in the currency markets. Look at this chart. The US dollar is strengthening significantly against the Japanese yen, hitting that 158 level. In times of global uncertainty like this, investors often dump riskier assets and they just rush into the perceived safety of the US dollar. It's a textbook risk-off move. Okay, so let's connect all these market jitters to the bigger economic picture, because this crisis is basically reigniting a threat that central banks they were just starting to think they had under control. The direct consequence of a sustained oil price shock is pretty simple: significant inflationary pressure. With oil being a key ingredient for everything from transportation to manufacturing, higher energy costs are just inevitably going to push up prices on everything right across the board. And this just throws a giant wrench in the plans for the US Federal Reserve. Before all this kicked off, the market was really hoping for and even expecting potential rate cuts.
But now, with these inflation fears roaring back to life, those cuts are looking highly unlikely. In fact, what we're seeing is central banks around the world pivoting back to a more aggressive or hawkish stance. That means they're more likely to keep interest rates high to fight off inflation. And if we look at the data from the CME FedWatch tool, we can actually see this shift in expectations in real numbers. The probability of a rate cut at the next Fed meeting has absolutely plummeted to pretty much zero. The market is now bracing for interest rates to stay higher for longer.
So with all this volatility and all this uncertainty swirling around, what are the key data points that we should really be keeping our eyes on to see where this is all going? Well, looking at the economic calendar from investing.com, all eyes are going to be on the data coming out of the US on March 11th. The consumer price index, the CPI data, that's going to be absolutely crucial for gauging inflation, even before the full effects of this oil shock really hit the numbers. And of course, the weekly crude oil inventories report will give us a direct look at the immediate supply situation on the ground. And all of this brings us back to that final, crucial question that really sums up this entire crisis. We've got a historic intervention in the paper market clashing with an unprecedented physical disruption. So the big question is, can a solution on paper truly solve a real-world bottleneck? The market's answer so far seems to be a resounding no. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks so much for watching. If you got something out of this, don't forget to hit that like button and subscribe for more updates. We'll see you next time.